What is up, guys? Welcome back to my channel, and today we're going to be talking about PayPal's recent earnings and the real reason why PayPal stock is actually down today. I've watched a few videos on PayPal's earnings and I've not seen anyone talk about what I'm going to talk about today, and this is the actual reason why PayPal got destroyed in the after hours. But before I get into today's video, let me talk about my Patreon account where you guys will be able to follow and see all my up-to-date thoughts on news on all earnings for different stocks, and you can gain exclusive access to my portfolio, what stocks I'm buying and selling. When the initial numbers were released for PayPal, the stock went flying down almost 8%, taking the stock from a $73 stock to a $67 stock. The EPS expected was 1.16, in which they reported 1.16, which was flat in terms of the expectations, neither a beat or a miss. And this led to a surprise of minus 0.29. Then the revenue expected, we were expecting 7.27 billion, in which PayPal reported the 729 billion, which was a slight beat. However, Wall Street saw something in these numbers, which led to this stock selling off today. Now, the initial earnings release was a big rush to work out why the stock was underperforming. And when I took a look at the numbers, I was going through seeing all good points. However, there's other reasons why this stock fell off. But when we took a look at the total payment volume, they delivered a 376.5 billion, which was 11% on the spot and FX neutral basis. They were expected to deliver closer to 372 billion, so they beat on the total payment volume, which was a big bonus. Again, the revenue was growing almost 7 and 8% when you take in the FX neutral basis. The GAAP at operating income growing to 1.1 billion, which was a 48% growth rate. And then the non-GAAP coming in closer to 20% at 1.6 billion. Then we take a look at the operating cash flow, which of 0.2 billion and free cash of 0.4 billion. And this included the 1.2 billion negative impact from the European buy now, pay later loans originated as held for sale. And I can get into this a little bit further of why there was actually this negative impact, but why this issue isn't a very big issue. Switching over to PayPal and KKR, recent announcement and strategic decision to work together on the pay later receivables scheme. This allows KKR to purchase up to 40 billion of eligible current and future PayPal pay later loans that are originated in Europe. And what this allows is PayPal to allocate more money to their incremental share repurchases, which they have upgraded from 4 billion approximately to 5 billion in total share repurchases, which is a great sign for shareholders. But the real reason why the $1.2 billion lag on free cash flow was due to the fact that this is a part of one loan, which we will then get back in the future quarters. Even though it's a drag on the current quarter, this 1.2 billion will be added back some point within the next 6 months. So this will be added to another earnings call, which will have free cash being much higher. And they still expect to deliver 5 billion as expected, which they said on the earnings call. So the initial earnings release had very strong numbers, and I was very shocked to see why this stock had actually sold off. But it was only until I took a look at the investor presentation and listened to the earnings call to understand further why this stock was down today. Looking into the PayPal metrics now, I was listening to the earnings call, and some of these numbers were much below my expectations of what I was expecting. However, PayPal did release a much more informed understanding of why the numbers are where they are and what they expect going forward, which puts me at ease in terms of what they can deliver. They have strategic points in place, which I'll break through later, but let's look into the PayPal metrics, and let's start with the active accounts, because we can see that they've gone from 429 million all the way to 435 million in Q4 22. However, from that point, we've seen a steady decline in Q1 23, going from 433 million all the way to 431 million in the latest quarter. So this decline is obviously not what we want to see, but the main thing is the number of payment transactions. So we can still see that the year-over-year growth has still increased nicely. However, it has slowed slightly, going from 16% in 22 all the way back down to now 10% in Q2 23. But that's still positive considering the active accounts have been down a few million, that we're still seeing the number of payment transactions still grow. Now, another positive, though, was the total payment volume. As mentioned, this has grown up nicely, going from 322 million all the way to 376 billion. Then we took a look at the year over year growth. It's still growing nicely, and it's actually been accelerating from 10% to 11%, which is a great sign that people are transacting further. And we are still making more money as that total payment volume increases, as mentioned. However, the biggest thing I noticed today was around the transaction margin. And this is a point where I initially thought that competition was biting at their margins in terms of PayPal's strategic decisions and where they can go with their margins. We can see in Q1 22, they were at a 50.9%, growing all the way to 51% at their high in Q3 22. But we can see there's been a big decline from 51% to 49, 47, and 45.9. So we can see that this transaction margin has been declining, which is a big worry. We're worried about other competitors biting into our market share, and meaning that we have to deliver a lower margin in order to compete at the current fees. So this will impact the bottom line, but the main driver of why this transaction margin was actually down was due to Braintree. Even though Braintree's growth has been very strong, it's a white label service, meaning that the margins are slightly lower. And this has contributed to the transaction margin decreasing over time. But they mentioned on the earnings call that they expect this to stabilize within Q4 2023. Now, just those PayPal metrics with the transaction margin and the active users decreasing was probably the two numbers in which I could find bad, because everything else in this report was fantastic. We saw the operating margin stabilize closer to 21.4%, which was a 230 basis point expansion to what they were expecting. So we can also see that this enabled the volume-based expenses, which grew 12.8%, and that drove the volume and the funding mix for unbranded processing growth. Again, the transaction expenses declined 11.7%, so they're becoming more efficient, which is what we like to see. And this is leading to margin expansion nicely. Again, the non-GAAP active operating income grew 20%, and this is all down to PayPal becoming a more efficient business. So the margin expansion was a great thing to see. But let's get into the free cash flow, particularly the buyback scheme, because I think this is very significant. So the capital allocation strategy for PayPal has differed throughout the years. We've gone from strategic buybacks in 2016 all the way to 2023, where we've increased massively in certain years, including 2018 doing 3.5 billion and 2021 delivering 3.4, 22 delivering 4.2, and then 2023 year to date already we've done 3 billion with the expected further 5 billion expected, which was guided. We've also done a lot of acquisitions through the years. 2018, when it's Venmo with the 2.8 billion acquisition, or the Braintree acquisitions as well. These are going to enable that growth, and we've also allocated a lot of money to CapEx as well. But the biggest thing has to be the share repurchases, and increasing that as shareholders gives us more of the pie of PayPal, and we're able to get a better price for what we're paying and deliver that EPS growth, which is so important. And this is a main driver of where I see value for PayPal. These buybacks will be fantastic for the future as a shareholder. So if we take a look now at the EPS, because we can see that in 22, we've gone from 0.88 to 2023 doing 1.16. So this is a big increase year over year, really, going from 0.9 to 1.16 or 23%. And we're only going to expect that to increase as we deliver more share buybacks. And this enables more of the pie, as I was mentioning. So this is a particular great strategic point. We are allocating cash forward, and it's a massive bullish point as a PayPal shareholder. Now, finally, let's talk about guidance of what PayPal are expecting going into the future. So they reiterated their guidance of around 20% EPS growth non-GAAP, which is fantastic. These buybacks are working, and this drives that EPS growth, as I mentioned. Free cash flow, they're expecting that to come in at 5 billion, which is fantastic. Gives us so much optionality, whether it's reinvesting into the business, using that for buybacks, or acquisitions and mergers. There's so many different factors we can do with that free cash flow, and being able to generate the free cash flow amount that we're able to just allows us to be a much more flexible business. Then looking further into the guidance, we can see the different revenues that they're expecting. We're expecting 8% growth, which is fantastic considering the year of inflation. And it's been a very tough year in terms of consumers not being able to spend as much due to the inflationary pressures. Again, net revenue, they're expecting it to come in around 7.4 billion for the next quarter. And then non-GAAP come in anywhere between 13 to 14%. And then EPS between the high end of 1.24 to the low end of 1.22. So these are good, strong numbers, which were reiterated. And they also mentioned on the earnings call that they expect to deliver the higher portion of what they're guiding, which is a good sign that the economy is slowly normalizing for PayPal and the total payment volume will be growing, which would be a great sign going forward for PayPal. So this was a big, large bulk of the earnings call. The investor presentation had some few snippets in there, whether it was Venmo or Braintree, but the largest point was around that transaction margin, which we've seen decline. It's the main reason why the stock has been down almost 8% in pre-market. Dan Schulman left a few nuggets in the earnings call as well, which we need to speak about, because he mentioned that they're in the final stages of delivering the next CEO to jump in his seat. Obviously, Dan Schulman is leaving at the end of 2023, so having that new CEO in place is going to enable us to get an understanding of their vision and where they have plans for PayPal going into the future. PayPal did also mention they've seen a lot of stabilization in the market with inflation coming down, which is a great sign that this stock can get back to normal, whether it's the normal margins or whether it's just growth drivers that are going to enable PayPal to become in a better position. But there's lots of different factors we can win with this company, because the share buyback scheme, having that free cash flow generation of 5 billion expected in the end of 2023, gives us so much optionality, as I mentioned. The EPS growth is going to be a great driver as well as shareholders, because this is part of that share buyback scheme. So there's lots of different ways we can win with this company. We're also in a huge space with the e-commerce space. So the total addressable market is massive with this company. So even with this increased competition with FedNow, Apple Pay, all these different competitors, believe me that PayPal is still in a very good position, and don't underestimate this company, because at $65 or $67 a share, this company is far too cheap and the numbers behind it support it. If you guys want to check out my other video on PayPal, I deliver a good breakdown in terms of the bullish points and also the bear case for PayPal. So make sure to check that out. And finally, if you guys aren't already, make sure to subscribe, leave a like, and I'll see you guys in the next one for more PayPal content.